Listen to me very carefully. If you are planning to hold silver, the next 72 hours are not just important. They are the difference between being positioned correctly for the greatest wealth transfer of your lifetime and watching helplessly as your opportunity evaporates. I am not speaking in hypotheticals. I am not giving you theories. What I am about to walk you through is mathematical certainty based on pattern recognition that has repeated 3 times in recorded history, and we are witnessing the 4th iteration right now. Silver just experienced something that has only happened twice before in modern markets. On January 29th, it touched $121.64 per ounce, an all-time record. Then, within 24 hours, it crashed 30%. 30% in one day? That is not normal volatility. That is a market dislocation. That is the kind of move that happens when something fundamental breaks in the system. And right now, as of February 1st, silver is hovering between $85 and $90 per ounce, sitting at the most critical technical decision point I have seen in precious metals in over a decade. Here is what nobody is telling you. The crash did not resolve anything. It did not fix the underlying dynamics. It created more instability, not less. And between now and February 7th, 6 separate catalysts are converging on the silver market simultaneously. Any one of these alone would be significant. All 6 hitting within 72 hours creates a pressure point that will determine the direction of silver for the rest of 2026 and possibly beyond. Most people holding silver right now have no idea what is coming. They think the storm has passed. They are wrong. The storm is just beginning. Before I explain what happens next, you need to understand the pattern. Not the pattern of silver, the pattern of empires. Because what is happening to silver right now is not really about silver. It is about what always happens in the final stage of imperial collapse. And this pattern has played out with mathematical precision 3 times before. Rome, 3rd century AD. The empire was overextended. Military costs were astronomical. Tax revenues could not keep pace. So they did what every failing empire does. They debased the currency. The denarius went from 95% silver content to less than 5% within 80 years. Prices exploded. The military turned on the government. The empire fragmented. Verified. The Dutch Empire, 17th century. They achieved reserve currency status through trade dominance. The guilder was the global settlement currency. Then came the wars with England and France. Massive debt accumulation. Loss of naval supremacy. Within 50 years, the guilder lost reserve status. The empire collapsed economically before it collapsed politically. Verified. The British Empire, 20th century. The pound sterling was the world's reserve currency for over a century. 2 world wars. Massive debt. Loss of manufacturing base. By 1944, Bretton Woods formalized what everyone already knew. The dollar had replaced the pound. Britain went from superpower to secondary player within a generation. Verified. Same pattern. Same sequence. Same outcome. Currency dominance leads to overextension. Overextension leads to debt. Debt leads to debasement or loss of confidence. Loss of confidence triggers capital flight into hard assets. The timeline compresses each time because information moves faster. Rome took centuries. Britain took decades. What is happening now is happening in years. The United States dollar has been the global reserve currency since 1944. 82 years. That is longer than most empires maintain monetary dominance. And right now, every single indicator that preceded the previous 3 collapses is flashing red simultaneously. The federal debt just crossed $36 trillion. That is 123% of GDP. Interest payments alone are now the largest line item in the federal budget, exceeding defense spending for the first time in history. The deficit is running at $2 trillion per year with no plan to reduce it. Not opinion, pattern recognition. But here is where it gets terrifying. The smart money is already moving. In the last 18 months, central banks globally have purchased more gold than at any time since 1950. China, Russia, India, Turkey, Poland. They are converting dollar reserves into physical metal at an accelerating rate. They are not doing this because they think the dollar might weaken someday. They are doing this because they have seen the same pattern we just walked through. They know how this ends. And silver sits at the intersection of 2 collapsing systems simultaneously. It is a monetary metal, so it benefits from currency debasement and loss of confidence in fiat. But it is also an industrial metal, increasingly critical for solar panels, electric vehicles, and electronics. Demand is at record highs. Supply has been in deficit for 3 consecutive years. Comex registered inventories, the silver that is actually available for delivery, sit at 124 million ounces. That sounds like a lot until you realize that is only enough to cover 15 days of global industrial demand. 15 days. Now let me tell you what converges in the next 72 hours and why this week is different from every other week. Factor 1. Silver is sitting at $85 to $90. This is not arbitrary. This range represents the battlefield between bulls and bears. Every major moving average is converging right here. Support from previous month's stacks at these exact levels. If silver holds above 90, the crash gets reframed as panic selling that has now stabilized. If it breaks below 85 decisively, we could see another cascade down to 70 or lower. The market decides which path it takes this week. Not next month. This week. Factor 2. Friday, February 7th, 8:30 a.m. Eastern Time. The January employment report drops. This is one of the most important economic data releases of the entire month. Markets are expecting moderate job growth, somewhere between 150,000 and 175,000 jobs added. But here's what matters. The jobs report directly impacts Federal Reserve policy expectations. Strong jobs data supports a stronger dollar and delays any possibility of rate cuts. Weak jobs data revives rate cut expectations and weakens the dollar. Silver crashed when the dollar strengthened on Trump's nomination of Kevin Warsh as Fed chairman. This single data release Friday morning could move silver 10% or more in either direction within hours. Factor 3. March silver futures positioning. Most of the action in the silver market is concentrated in the March 2026 contract. Traders are rolling positions from February into March, and this is creating unusual dynamics. March options are seeing massive open interest accumulation. Both calls and puts are being bought aggressively. That tells you something critical. Traders with serious capital are positioning for major volatility in either direction. They do not know which way it breaks, but they are certain it breaks hard. These are not retail speculators. These are institutional players moving tens of millions of dollars. They see what is coming. Factor 4. Friday, February 7th, 3:30 p.m. Eastern Time. The same day as the jobs report. The weekly commitment of traders report gets released. This shows exactly how large commercial traders, managed money funds, and small speculators are positioned in silver futures. We are waiting to see if positioning changed dramatically during and after the January crash. If commercial traders, the smart money, reduced their short positions during the crash, that signals they think the bottom is in. If they maintained or even added to shorts, they are expecting more downside. This data reveals what the players who move hundreds of millions of dollars actually believe is coming. Not what they say on television. What they are doing with their own money. Factor 5. Comex inventory updates. These happen daily, and this week they are critical. We are watching post-crash physical flows. Did the crash trigger mass deliveries of physical silver out of Comex vaults? Or did it bring metal back in? In early January, before the crash, 33.45 million ounces were withdrawn in just 7 days. That was unprecedented. Total registered inventory that is actually deliverable sits at only 124 million ounces out of 440 million total. If withdrawals continue this week despite the crash, it confirms that physical demand remains ferociously strong regardless of paper price. If inventories build, it challenges the entire supply squeeze narrative. We find out which reality we are living in over the next few days. Factor 6. Physical dealer premiums. This is the real-time indicator of true demand that nobody in the paper markets can manipulate. During the rally to 121, premiums spiked hard. After the crash to 78, early reports suggest premiums stayed stubbornly high. 1-ounce silver eagles are still commanding $6 to $8 over spot. 10-ounce bars are $3 to $5 over spot. If premiums stay elevated this week, it is absolute proof that the crash was a paper market event not reflecting physical reality. The divergence between paper price and physical availability is the signal that something is breaking. If premiums compress, it signals genuine selling pressure across both paper and physical markets. We are watching this daily. These 6 factors, all hitting within 72 hours. That is the convergence. That is why this week is not like other weeks. That is why the next few days matter more than the next few months. Now let me explain the timing, because this is where most people lose money. Markets do not move in straight lines. They consolidate for long periods, then explode in short bursts of violent movement. We just experienced one of the most violent moves in silver's history. 30% in 24 hours. That was not normal volatility. That was a system break. And system breaks create massive opportunity, but only for people who are paying attention and positioned correctly before the next move happens. Here is what typically follows violent crashes like we just witnessed. Scenario 1. The dead cat bounce fails. The market rallies slightly for a few days. Everyone thinks the worst is over. Confidence starts returning. Then another wave of selling hits without warning, and prices make new lows. This is the scenario that destroys people psychologically because they think they survived, and then they get hit again even harder. Scenario 2. The V-shaped recovery. The market finds a legitimate bottom very quickly. Panic sellers exhaust themselves. Strong hands with capital step in and accumulate aggressively. Prices surge back within days or weeks. This is the scenario where people who sold the bottom experience maximum regret because the recovery happens so fast they cannot get back in. Scenario 3. The multi-month grind. The market enters prolonged consolidation. It chops back and forth violently, going nowhere. It frustrates everyone. Bulls get stopped out on dips. Bears get stopped out on rallies. Nobody makes money. This continues for months until a new catalyst emerges that finally forces a directional move. This is often the most painful scenario because it damages positions without providing any clarity. Scenario 4. The bear trap squeeze. This is the one that catches the most people off guard. First, silver drops below 85 early in the week. Stop losses trigger. Headlines scream about another crash. Panic selling resumes. It looks exactly like scenario 1. Then, on Thursday or Friday, something shifts. Maybe weak jobs data. Maybe Comex inventories show massive withdrawals. Maybe physical premiums spike to levels that cannot be ignored. The buying comes in hard and fast. The move reverses violently. Prices surge past where they started the week. Everyone who panic sold is left behind. Those who held or bought the dip get rewarded massively. Shorts get squeezed into covering. This scenario transfers the most wealth in the shortest time. The next 72 hours will tell us which scenario we are in. If silver holds 85 to 90 through Friday's jobs report and shows strength, scenario 2 becomes likely. If it breaks decisively below, scenario 1 becomes likely. If it chops violently but ends near where it started, scenario 3 becomes likely. If it drops first then reverses explosively, scenario 4 becomes likely. Most of the gains or losses you will experience in silver over the next 3 months will be determined in the next 72 hours. Not because fundamentals changed, but because the market is choosing its path right now. Let me show you historical parallels so you understand what we are dealing with. March 1980. The Hunt brothers attempted to corner the silver market. Silver hit $50, then crashed to $10 over the following months. It bottomed in 1982, then spent nearly 2 decades in the $4 to $8 range before rallying in the 2000s. That crash took a generation to fully recover from. April 2011. Silver hit $49.82. Then it crashed to $32 within days. It bounced back to $43 briefly, then crashed again to $26. It took until 2020, 9 years later, to sustainably break above $25 again. Even with strong fundamentals and growing industrial demand, the technical damage took nearly a decade to repair. March 2020. The COVID crash. Silver dropped from $18 to below $12 in a matter of days. Everyone thought the world was ending. Then it reversed and ran to $30 within 4 months. The people who survived that drop and held their positions or bought more got extraordinarily wealthy. The people who sold the bottom at 12 missed the entire recovery and spent years regretting it. January 2026. The 121 crash. 30% in 24 hours from all-time highs. This is the one we just lived through. The question everyone is asking now is which historical parallel are we following? Are we at the beginning of a multi-year bear market like 1980? Are we in the middle of a prolonged consolidation like 2011? Or are we setting up for an explosive recovery like March 2020? The next 72 hours provide the critical clues that answer that question. Now let me tell you what different types of silver holders should be doing right now, because your situation determines your strategy. If you are a long-term physical holder, someone who bought silver for fundamental reasons and stores it personally, your action plan is simple. Do nothing different. The next few days matter intensely for traders. They do not necessarily matter for you. Yes, the crash hurt. Watching 30% disappear in one day is traumatic regardless of your time frame. But if you bought at $30 to $40 per ounce, you are still up double or more. The volatility is the price you pay for being positioned in a hard asset during currency collapse. Do not let short-term price swings shake you out of a position you took for long-term reasons. Be psychologically prepared that if we get the double bottom scenario, your portfolio value will drop further temporarily. Decide right now, before it happens, that you will not panic sell. If you have available capital and silver drops to 75 or 80 this week, consider adding to your position, but only if you can hold for years without needing that money. If you are an active trader, someone managing positions on shorter time frames, you are probably hurting right now. The January crash likely damaged your account. Here is what you need to do. Reduce position sizes immediately if you have not already. The uncertainty over the next 72 hours is too high to be fully exposed. If you have gains from current levels, take some profits. Lock in what you have. If you are underwater, tighten your stop losses, but understand that volatile moves can gap right through stops and fill you at worse prices than you expect. Have a written plan for each scenario before it happens. Know exactly what you will do if silver breaks above 95. Know exactly what you will do if it breaks below 82. Do not make these decisions in real time during fast-moving markets when your emotions are screaming at you. Friday's events at 8:30 a.m. and 3:30 p.m. are extraordinarily high-risk moments. Be especially careful with position sizes around these data releases. If you are using leverage, futures, options, or leveraged ETFs, you probably got liquidated or severely damaged in January. If you are still using leverage after that, I need you to hear this clearly. Deleverage now. I am not suggesting this. I am telling you this as a survival imperative. The next 72 hours could easily produce another 10 to 20% move in either direction. That will destroy leveraged positions. We just witnessed what 30% in one day does. It can happen again. If you absolutely must use leverage, use far less than you think is appropriate. Cut your normal position in half, then cut it in half again. Volatility is extreme. Gap risk is massive. Margin calls happen faster than you can react. Leverage is what transfers wealth from overconfident traders to patient holders during moments like this. If you are considering entering a silver position right now, thinking maybe the crash created a buying opportunity, here is my advice. Wait for clarity. Do not buy before Friday's major data releases when the outcome is highly uncertain. Let the move happen. Let the dust settle. Then make your decision based on new information. Yes, you might miss the absolute bottom if the recovery or squeeze scenarios play out. That is the price of prudence. But you will avoid catching a falling knife if the double bottom scenario plays out, and that protection is worth far more. If you must enter right now, buy physical metal, not paper. Buy small amounts. Dollar cost average over days or weeks. Do not go all in on a single entry point when we are sitting at a major inflection point with massive catalysts arriving within hours. Let me tell you exactly what I will be watching over the next 72 hours, because these are the specific signals that tell us which scenario is unfolding. Monday through Wednesday, I am watching price action at key levels with absolute laser focus. $90. If silver closes above this level for 3 consecutive days, it strongly suggests the bottom is in and we are entering recovery mode. $85. This is the absolute make or break level. Holding here is crucial for any bullish scenario. $82. If we break decisively below this, the next support is 75 and panic could accelerate rapidly. $78. This was Friday's crash low. If we test this level again and break it, we are in serious trouble and panic selling could resume with vengeance. Volume matters as much as price. High volume at support levels is bullish because it shows buyers stepping in aggressively. High volume on breakdowns is bearish because it shows sellers overwhelming buyers. I will be checking 4-hour candles at these exact levels constantly. I will be monitoring physical premium changes at major dealers daily. Are Silver Eagle premiums staying high at $6 to $8 over spot? Are generic round premiums stable at 3 to 4 over spot? Are dealers reporting supply shortages or having to allocate limited inventory? Are buyback spreads widening? meaning dealers are paying less to buy metal back from customers. If premiums collapse, it signals demand evaporated and the shortage narrative is wrong. If premiums stay elevated despite the 30% crash, it signals strong physical demand that paper prices are completely disconnected from. On Tuesday and Wednesday, I'm watching Comex inventory data closely. Daily updates will show whether registered silver is still being withdrawn despite lower prices. Continued outflows would be extremely bullish, proving physical demand remains strong. Inventory builds, on the other hand, would be bearish and suggest the shortage narrative is weakening. On Thursday, I'll focus on how silver trades ahead of Friday's jobs report. Is it rallying, selling off, or going nowhere? Positioning before major data reveals what smart money expects. Friday at 8:30 a.m. Eastern, the jobs report hits. I'll watch payrolls, unemployment, wages, revisions, and especially the dollar's reaction. Then I'll watch silver's response. A strong move often sets the tone for weeks. Later Friday, the commitment of traders report shows who really controls the market. It reveals whether institutions covered shorts, liquidated longs, or increased exposure. This data can shift sentiment fast, but the biggest challenge is psychological. Whether you held, sold, or bought the dip, you're under pressure. Fear, regret, and uncertainty are intense. Your mind will urge you to act emotionally. The solution is simple but hard. Decide your plan in advance and follow it. Markets reward discipline, not reactions. Let me be transparent about my positioning this week. I hold physical silver that I'm not selling under any circumstances. This is a long-term position based on fundamentals, not short-term price moves. The January crash hurt on paper, but my reasons haven't changed. I bought for years, not months. I took some profits during the rally, and that cash is ready if we see another extreme dip. I have zero leverage. None. The January crash proved that leverage in this market is financial suicide. I'd rather hold a smaller position I can keep forever than a larger one that gets liquidated in a day. I'm prepared for extreme volatility. I've accepted that my portfolio could swing 20% in the next 72 hours, and I won't make emotional decisions. I'm watching closely. Prices, data, sentiment. Information creates options. If we get a recovery rally, I'll add on pullbacks. If we get a double bottom, I'll deploy capital lower. If we get choppy action, I'll wait. This is not financial advice. This is transparency. Your risk tolerance and timeline are different. Make your decisions consciously, not emotionally.